Hey everyone, Larry Bass with Mortgage Achievers, and today we're going to talk about what in the world are closing costs? Or, in simpler terms, how do we understand the confusing numbers of a mortgage loan? I'm your host today. We'll be going through 7 or 8 slides just to recap what closing costs, how they are broken down into down payment, prepaid and reserves, and fees. If you have any questions after that, feel free to give me a call. 303-944-2277. I'm here in the Denver area and I'm your mortgage guy. And so let's get started. Okay, we're going to talk a little bit about what closing costs are. Now that's the general term. It's kind of like Kleenex. Really, you want a tissue or something like that, and everyone just thinks of Kleenex. Now, closing costs in the mortgage world actually incorporates 3 basic groups of monies. The first one is the down payment, and the down payment is what you have, the skin in the game on the loan. Obviously, if it's a zero down loan, such as a USDA loan or a VA loan, well, then the borrower really has very little money, if any, into the transaction. So if they let the house go, they really haven't lost a lot except their credit and things like this. Then you of course have low down payment loans like a 3% or 5% down conventional loan and or 3.5% FHA loan. We'll talk about those in just a moment, but that's what the borrower has in the skin in the game. That's one part of closing costs, and then that's the largest part usually. The next part are the fees. Now these are just the fees, that the cost of getting the loan. We have to pay for an appraisal, pay for the underwriter, pay for the process and the credit report, different fees, and we have a slide on roughly what those fees are going to be. And then next is the escrow account. Now an escrow account is just basically a forced savings account, and in that are 2 groups of monies. One are called prepaid monies or fees, and the next are reserves, and we have a slide for each of those. So let's get to the first slide regarding the down payment. Okay, the down payment. So as you can see on the slide, I have roughly 3 different types of numbers. The first is the zero down, which is a VA loan or a USDA loan. Next we have 3% to 20% or more for conventional loan, and then finally, which is very common, is an FHA loan, which requires 3.5% down. So you can see my illustration. The way it works is the down payment is based on the sales price. So if you're buying a home or property for $200,000, obviously zero down means you're getting a loan for $200,000. Now with a conventional loan, you can go as low as 3% down. So 3% of $200,000 is $6,000 is down, or you can go to 20%, which would be $40,000 down. So your loan amount would be $160,000, the 40 from the 200. And sometimes people will do 20% down because then they don't have what's called mortgage insurance. If you put less than the 20% down, you'll have some type of mortgage insurance on the loan. And then next, the very common loan is your FHA loan, and it's a 3.5% down, and that's the illustration I used here at the bottom of the slide. So if your $200,000 sales price, you take that times 3.5%, or 200,000 times 0.035, and that gives you $7,000. So as far as your closing costs, the down payment part of the closing costs on an FHA loan at $200,000 sales price is $7,000. So hopefully this slide makes sense, and now we're going to go to the next part, which is the fees, and how everyone has their hand in your back pocket. So see you on the next slide. Okay, the fun part where everyone has their hand in your back pocket. Okay, as you can see on the screen, we've got the appraisal. Now, the appraisal is actually to protect the lender. It will protect you in a sense too, making sure you're not going to be paying, really much more than the fair market value at the time you buy the property. So 2 years from now, your house will appraise at a different amount, either higher or lower than what it does now. But that's what the appraisal is, and you can see the costs are in that really $550 to $575 range. Next, we have a credit report. Of course, the credit report deals with two things. It shows your willingness to pay and your ability to pay. For example, there's some people who just would definitely pay all their bills on time, but they just aren't making enough money. And then we run into a lot of other people who make a lot of money, but they're just not organized to pay their bills when they're due. And so that reflects poorly on their credit report as well. A couple fees. You got a flood certificate just to make sure your house isn't in a flood zone. If it is in a flood zone, you can expect several $100s a year to pay for flood insurance. Lender's title, that is protecting the lender to make sure there are no liens against the property because they want to be in first place. Then we have the processing fee. That's where we have a third-party processor who does make sure everything is done properly and on time, and very important part of the team. Then we have recording. That money goes to the state, as well as a tax service is just a one-time fee the lender charges to have your taxes be reported to the lender each year and how much is due. And then underwriting, that goes to the investor. So here's how this works. I'm a mortgage broker. My company is called Mortgage Achievers Corporation. Now, I'm a broker like you would go to an insurance broker, maybe, and they would shop for car insurance for you, maybe through Geico or Nationwide or through someone like that, and try to find you the best deal. Well, I do the same thing, but it's on the mortgage world. A lot of we call them lenders or / investors, are people you've never heard of. Stearns Mortgage, EA Loans, The Money Source, United Wholesale Mortgage. You've heard of Wells Fargo and Chase and those guys, but a lot of times their pricing actually is not as good as the pricing of these other unknown people who we use, and then they usually will sell the mortgage to people like Chase and Wells Fargo, and then those companies become what they call the servicer, which means they're the ones who you'll ultimately make your payment to month after month, year after year. So here is a typical range of fees as part of your closing costs. So again, we have the down payment, which again was the percentages. So in our example was $7,000, and now we have these fees, which probably add up to around, roughly around $3,200. And so now we will go to our next slide, which is what they call the prepaid and our reserves. So see you on the other side.